Using CFDs to hedge. Aside from utilizing CFDs for speculative gains, contracts for differences can also be used as a powerful risk protection tool for those who understand the power behind this simple investment product. Hedging is the action of taking an equal but opposite position, usually through a derivative, such as a contract for difference, in order to mitigate or reduce the risk of an existing open position. It's also important that you understand that at any time you hedge your financial position, you are accepting that you may lose some potential profit. There is always a trade-off, and hedging is like an insurance policy. It's a preservation strategy rather than a way of making money. So there is a price to pay in terms of lost profits, but a correctly implemented hedging strategy will avoid you having to take large losses. The ability to go long or short and to leverage trades makes CFDs a good tool for implementing hedging strategies. Let's say an investor has a physical portfolio of shares, commodities, or foreign currency he believes could take a hit in the coming weeks. He could hedge that risk by taking an opposing position with a CFD. To avoid losses, you could sell your shares, wait while the value drops, and then possibly buy them again at a lower price. But this would be speculating on a market fall, an entirely separate exercise, rather than hedging your portfolio. After all, the market may not fall. A hedge allows a trader to offset any losses in a long position with profits from an opposite short position. If you have a portfolio of shares and you are concerned that a market downturn is imminent, you may wish to hedge against this event. Here's a hedging example. Now let's suppose that it is the last week in January and an investor holds a portfolio of blue chip stocks worth about £55,000. The FTSE is trading at about 5,500. For capital gains tax purposes, the investor would prefer not to sell his shares until the new tax year in April, but he is still concerned that his portfolio would fall in the meantime because of widespread troubles in North Africa. So he decides to buy one short CFD on the FTSE at £10 per point, providing him with a £55,000 short exposure to the FTSE index. On the 10th of March, the FTSE falls nearly 8% to around 5,060, and the drop has wiped about £4,200 off of his stock portfolio. The CFD has moved 440 points in his favor and has earned him around £4,400 profit on that trade. For a nominal amount, he has bought himself an almost perfect short-term hedge. Let's say you're interested and you'd like to know when you should get involved in CFD hedging. You should get involved when the wider market or a particular stock you are invested in is moving against you, when a market position has already moved sharply in the direction of your trade and additional gains may be marginal, when the wider market looks weak and doesn't react to positive or negative news. Here's when you should avoid hedging. You should not get involved when a trade has moved sharply against you, as the market is prone to reversing, and where hedging near these levels, all you would be doing would be locking yourself into a large loss. Avoid hedging in general during raging bullish markets when everything seems to be going up. For more information, visit www.contracts-for-difference.com.